Most people think volatility means something is wrong. Every time XRP makes a sharp, aggressive move, the reaction is almost always the same. Suddenly, frustration appears, confidence disappears, and people start saying that XRP must be broken, manipulated, or fundamentally flawed. But that reaction doesn't actually reveal anything about XRP. It reveals something about how most people misunderstand volatility. So instead of arguing about whether an asset is real or fake, which never leads anywhere meaningful, it's worth stepping back and asking a deeper question. Why do moves like this happen? What do they actually represent? And how do you tell the difference between something collapsing and something behaving exactly the way markets are designed to behave? Here's the pattern that shows up again and again. The people who lose conviction during volatile moments are rarely wrong about the asset itself. They are wrong about the type of market they are participating in. And once you understand that difference, volatility stops feeling like a verdict. It starts feeling like information. Just to be clear, this is not financial advice. Nothing here is a recommendation to buy or sell anything. This is simply a framework for understanding what happens when markets move fast, and why those moments feel emotionally overwhelming. If you've ever felt your confidence get tested when XRP moves suddenly, you're not alone. Most people experience it. They just don't talk about it openly. So let's break down what's actually happening when we see moves like this. A few days ago, XRP moved sharply in a very short period of time. The price dropped aggressively, and for many people, it felt chaotic, unpredictable, and alarming. But it's important to understand something critical. When XRP moves violently in a compressed time window, it's usually not because millions of long-term holders suddenly decided they no longer believe in it. That narrative is convenient, but it's rarely accurate. Most of the time, what you're actually watching is leverage being forced out of the system. Leverage behaves nothing like real conviction. Conviction waits. Conviction thinks. Conviction has patience. Leverage does not. Once price moves against leverage positions, liquidation happens automatically. One liquidation pushes price just enough to trigger the next one, then the next one, then the next one. Before anyone has time to emotionally process what's happening, the system is already unwinding itself. That's why these moves feel violent. They're not emotional events. They're mechanical events. And this is the key distinction most people miss. If demand had truly disappeared, price wouldn't stabilize the way it does after these flushes. You wouldn't see buyers step back in. You wouldn't see structure reform. You wouldn't see equilibrium return. Instead, what you usually see is stabilization. Not immediate upside, not guaranteed recovery, but breathing room. What just happened was not a thesis collapse. It was a risk reset. And if you don't understand the difference, every volatile move will feel personal. Every wick will feel like a signal. Every fast candle will feel like a warning. But once you understand the difference, something changes. You stop assigning meaning to every price fluctuation. You stop reacting to every emotional narrative. And you start asking better questions. That's where real conviction comes from. When volatility hits, there are two types of people. Some strengthen their conviction. Others completely lose it. The difference is not intelligence, it's framework. When price moves aggressively, it's easy to jump to conclusions. But conclusions without structure are dangerous. So instead of reacting, the first thing to do is evaluate what actually changed. The first question is simple. Did usage change? Did the system stop functioning? Did transactions slow down? Did the network fail to do what it was designed to do? The second question is deeper. Did integration change? Did developers walk away? Did infrastructure get pulled back? Did participants disappear? The third question is strategic. Did institutions retreat or did they lean in? Because those two realities look very different if you're paying attention. And finally, the most important question. Did the thesis break? Not the price, not the sentiment, not the mood. If the answer is no, then what you just witnessed wasn't a hidden truth being exposed. It wasn't a scam being revealed. It wasn't a fundamental collapse. It was the market testing who can sit through discomfort without rewriting their entire belief system. That's the part most people don't want to admit. Volatility does not invalidate a thesis. Misinterpreting volatility does. And once you understand that, fear stops dictating your conclusions. Once you understand how to separate structure from emotion, something interesting happens. You stop reacting to price like it's a verdict on your intelligence. You stop interpreting every drop as a sign that you were wrong. And instead, you begin to see volatility for what it really is, a stress test, not of the asset, but of the people holding it. Because markets are not designed to reward certainty. They are designed to reward those who can stay rational, while everyone else is emotionally overwhelmed. And that's why volatility feels so personal. It's not just about watching price fall. It's about watching your confidence get challenged in real time. When people say, "This must be a scam," what they're really saying is, "I don't understand what I'm watching." And that's not an insult. That's human nature. Fear always looks for a story. When price moves violently, the mind tries to create meaning. It tries to build a narrative that makes the discomfort feel logical. But most of the time, the story is wrong. Because strong theses don't eliminate volatility. They contextualize it. Instead of asking, "Why is this dropping?" the better question is, "What does this moment reveal about positioning, patience, and psychology?" Markets don't move in straight lines. They never have. They never will. And infrastructure doesn't get adopted in a way that feels comfortable. It emerges quietly. It integrates slowly. And then one day, it becomes unavoidable. That's why price is reactive, while structure is directional. Price fluctuates, structure evolves. And as long as the direction hasn't changed, rewriting your thesis every time the market gets uncomfortable is not analysis, it's anxiety. This doesn't mean risk doesn't exist. It means most people misunderstand where risk actually lives. Most of the time, the risk isn't in the asset. It's in the lack of framework. When you don't have a framework, every move feels existential. Every drop feels catastrophic. Every pump feels like validation. And that emotional cycle is exactly what markets exploit. Moves like the ones we've seen recently do not test whether an asset is real or fake. They test whether your understanding is strong enough to withstand uncertainty. If every volatile move forces you to question your entire position, then the issue isn't the asset. The issue is that your framework collapses under pressure. That's why these moments feel so intense. People aren't just watching charts, they're watching their beliefs get challenged. And when someone can't separate structure from emotion, the easiest conclusion is always the same. This must be manipulated. This must be a scam. This shouldn't be happening. But markets were never designed to feel fair. They were designed to reveal who understands them and who doesn't. One of the most important realizations is this: even the strongest theses do not remove volatility. They simply make it interpretable. So instead of constantly asking why price is moving, you start asking different questions. Is reliance increasing? Is integration expanding? Is infrastructure becoming more embedded in serious conversations? Is the system showing up when scale and pressure matter? Because real infrastructure doesn't announce itself with excitement. It appears quietly, it grows steadily, and then suddenly it becomes essential. That's why price alone is not enough to validate a thesis. Price reacts to sentiment, structure responds to necessity, and as long as necessity is increasing, temporary discomfort does not invalidate long-term direction. That doesn't mean you ignore risk. It means you understand what kind of risk you're actually dealing with. Most people think they're managing market risk. In reality, they're battling psychological risk. They want upside without discomfort, conviction without context, certainty without understanding. But markets don't work that way. Transitions don't work that way. And infrastructure certainly doesn't work that way. Volatility is not an anomaly. It's the cost of participation. And the goal is not to endure it emotionally. The goal is to be positioned intelligently enough that you don't feel the need to react at all. That's where real confidence comes from. Not from prediction, not from optimism, not from blind belief, but from clarity. Clarity about what you're holding, clarity about why it exists, clarity about the role it plays in a system larger than price charts. Most people holding digital assets don't truly understand them. They understand narratives. They understand headlines. They understand price. But understanding structure requires slowing down. It requires studying how liquidity behaves, how money moves, how systems evolve. And that's the part most people skip. They want certainty without comprehension. But certainty is never given in markets. It's built. And the people who build it are the ones who stop panicking when volatility shows up. Because volatility will always show up. It always has. It always will. So when the next violent move happens, and it will, the question isn't whether the asset is broken. The question is whether your framework is. If your confidence depends on smooth price action, it will collapse every time the market gets uncomfortable. But if your conviction is built on structure, integration, and long-term necessity, then volatility stops feeling like an attack. It starts feeling like a process. And once you understand that process, something shifts. You stop chasing validation. You stop reacting to noise. You stop rewriting your beliefs every time the chart moves. Instead, you become strategic. Because the truth is simple. Markets don't reward those who feel the most. They reward those who understand the most. And understanding volatility is not about predicting price. It's about recognizing that discomfort is not evidence of failure. It's evidence of transition. So when XRP moves violently again, and it will, remember this. It's not testing whether the asset is real. It's testing whether your understanding is. And if you can see that clearly, then volatility no longer controls you. It informs you. That's the difference between reacting and positioning. That's the difference between fear and framework. And that's why, in most cases, volatility breaks people long before it ever breaks XRP.